Hello, everyone. My name is Rob Morris. I'm a director at PwC in the New York office. So good morning from New York and good afternoon to everyone. With me today, I'd like the other panelists to introduce themselves briefly. Nancy?
Thanks, Rob. I am here in not-so-sunny Philadelphia, where I can assure you it is not always sunny. But my name's Nancy Manzano. I'm a tax director here at Vertex in our Chief Tax Office. I've been at Vertex for just over 5 years. And just a quick glimpse of what the Chief Tax Office is all about. We're a group of deep subject matter experts in taxation that advise the business on tax trends, and we work with our product teams to ensure that Vertex products and services are relevant and usable by our customers. Prior to coming to Vertex, I spent over 25 years with a combination of Big Four and industry. I led tax departments in some Fortune 500 companies, primarily in the financial services industry, and I focused on global tax and tax operations.
Thanks, Nancy.
Hi, my name is James Vinneman. I'm a senior indirect tax manager in the indirect tax practice in London. I primarily work with European-based businesses to manage their automation opportunities. So a lot of what our team does here is for European-based multinationals is help companies deal with how to calculate and remit sales tax in kind of an efficient and cost-effective manner.
Great, thank you, James. And again, my name is Rob Morris, and here at PwC, I've been focusing in the indirect tax space, mostly on sales and use tax for the last 10 years, and actively following and engaged in sales and use tax nexus issues, and the Wayfair decision, which is the topic for today. So very high-level agenda slide that we have up here is an overview of if you've joined us today, what you can expect to hear and what you can expect to cover. If you're a foreign company and you're doing business in the United States, if you have any type of footprint there or business activity, this Wayfair decision really affects all industries, either directly or indirectly, and we'll try to have a robust discussion around that with some Q&A at the very end. So high level, today, I think it is always helpful to do a quick 5 minutes, an overview of sales and use tax in general. I've found in other meetings and presentations, it does help provide context. While the sales and use tax does have many similarities to the value-added tax, there are, of course, some very important differences. So we'll cover that briefly. Then I'll go over the decision itself, and what it means, and where we're going from there. There are a few additional letters here of other talking points that we may or may not be able to get to, depending on time, because I really want to make sure that we do leave enough of a window to consider the practical considerations for foreign sellers. That's really the purpose of today's webcast, and we want to be as informational as possible. So with that, we'll jump to a quick 5-minute sales and use tax overview. And again, the purpose here is just to level set and create some context. If you're more familiar with that and not as much with sales and use tax, there are a few key important distinctions to be aware of. I think one thing to start off, sales tax is generally applied to the retail sale of tangible personal property and only certain services. The U.S. states operate in many ways like independent countries, and the sales tax is a subnational tax. It's not at the federal level. And so you have 45 states with relatively different and unique sales and use tax laws, which creates a lot of fun for me and my colleagues. So generally speaking, tangible property is going to be subject to sales tax in almost all of these states, really all these states. And then the states only tax specifically enumerated services. Some common examples are information services, data processing services. Software is a big one, so cloud computing, software as a service. Also, in the most recent 5 years or so, digital products and services are increasingly more likely subject to tax. The state rate can vary, and sales tax rates are usually a combination of state, county, local, and sometimes additional rates associated with transportation and the likewise. So in total, it can range. The state rate usually ranges from 4 to 7%, but the total rate can range more like 7 to 10%. So lower than most VAT rates, but it is applied a little bit differently. The complement to the sales tax is the use tax, and use tax applies if the vendor does not appropriately charge sales tax. So if you're a company doing business in the United States, you have to think about not only what you're selling, but also your purchasing. And in most instances, if the vendors are not correctly charging you sales tax, you technically and legally have a use tax obligation to accrue yourself and remit that tax if it wasn't charged appropriately. And that moves us on to sales and use tax nexus. Nexus is a legal term of art. It's been defined by the courts over the last 50 years, and it's really the focal point of our conversation today because that definition has changed over time. The Supreme Court decision we're talking about today is really a landmark case because it overturned 50 years of precedent about what constitutes nexus. But generally speaking, traditionally, pre-Wayfair, if you will, the law required some sort of physical presence in the state to establish nexus for sales and use tax purposes. Now, that's been chipped away at over the last decade or so, and normally our presentations and discussions would cover concepts such as affiliate nexus, click-through nexus, notice and reporting requirements. A lot of these things have gone by the wayside to some extent because the new Wayfair rules really make some of this less relevant. But nonetheless, physical presence, it should be noted, is still an important concept and is still likely to establish nexus. So, for example, if you have a storefront or office or any physical property in a state, if you have employees or agents or others working on your behalf to establish a market, these have always been sufficient to establish sales and use tax nexus in the United States. And so if you are a company that's doing a nexus review, you need to really consider your pre-Wayfair presence as much as your post-Wayfair presence.
So for the benefit of our participants who are maybe novices in the area of U.S. sales and use tax, we thought we'd spend a few minutes explaining some of the characteristics of the taxing regime that really make the administration of it so challenging for businesses. As Rob pointed out, there are 45 states and the District of Columbia that impose sales and use tax, but it's important to understand that there are over 10,000 sub-state jurisdictions, and those include things like cities, counties, parishes, special districts, other local taxes. So you can have thousands of jurisdictions with different rates, and that's bad enough, but you also will have situations where there's non-uniform taxability rules. In other words, what's taxable in one jurisdiction can easily be exempt in another jurisdiction. Furthermore, there's disparate rules around the follow-on charges that come with a transaction, like freight charges, installation service charges, and the like. Next, some of these sub-state jurisdictions are administered at the state level, but others are self-administered. And what this means is that you may end up having hundreds of filings in just one state. So that makes it challenging to deal with. And to make it more complex, the boundaries around these taxing jurisdictions do not neatly line up with political or zip code boundaries. So very often you may need some additional data points around your customer ship-to addresses to calculate the correct amount of tax. And just when you think you've got it all figured out, obviously those tax rates and taxability rules can change regularly, and that requires sellers to keep up to date with those rules, sometimes as often as monthly. And further complication can result from some special temporary rules. There's a very common scenario here. We call them sales tax holidays, and that is really when you have a temporary suspension or reduction of a tax rate. They're very common here for things like back-to-school season, or maybe they cover a specific type of purchase. But again, they're temporary, so they're there for a period of time and then they go away. Exemption and resale certificates are also challenging to manage. They have to be collected and maintained and also regularly updated, and that is done to protect the seller in case of an audit, which is pretty assuredly going to happen. And then lastly, jurisdictions can have complex sourcing rules, and that's really what governs how you determine where to tax a transaction, and that's particularly challenging and most applicable when you're talking about taxation of services. And there are a growing number of states and other jurisdictions that have been enacting or expanding their tax base to include services. So I'll pass it back to Rob.
Yeah, thanks, Nancy, and that's a great point about the sourcing. I feel like, you know, my more recent focus has shifted a lot to sourcing recently for sales and use tax purposes. For tangible property, traditionally it's been easier because it's the location, the transfer of title or possession. In our new service economy, and especially the internet economy, is there's so many new and different digital products and services, different technologies, and different software. Sourcing becomes a much more interesting and complicated question. So it's particularly relevant for these ideas of economic nexus because, as I'll segue to now, the Supreme Court decision and its ramifications are closely tied now to new revenue standards, and how much revenue you're deriving in a certain state is potentially sufficient to trigger and establish economic nexus. So let's talk about the case really quickly, and then we can move on to what it means and what we should do going forward. Again, the decision was fairly recent. It was June 21st. But as I'll talk about in a second, it has been a few months, and there has been a ton of state activity in response to this decision. And these are why it's going to be important to know what you may already need to do. It's really not a wait-and-see game anymore, and we'll get to that in a second. But another important reason this is a landmark decision, the Supreme Court had considered sales and use tax nexus in two other prior cases, National Bellis Hess and then Quill in 1992, which upheld Bellis Hess. And as I mentioned at the beginning of the presentation, nexus is a legal term of art that was defined by the courts, and this physical presence standard was a bright line rule. It was created, it was court constructed. It was an interpretation of the Constitution that essentially a physical presence is required in a state in order to establish nexus, and that's really been the rule for the last 50 years. There are pros and cons to bright line rules. On the positive side, it gave businesses more certainty, so to speak. It helps with planning. It helps you understand when you do or don't necessarily have state tax requirements and obligations. Because again, if you establish nexus in a state, basically that gives the state the right to require you to oblige by its various state taxes. And that's not just sales and use tax. Income tax is also an important conversation or component that should always be part of the conversation. We'll mention that a bit later in the slides. But if you're considering one, you should be considering both. And it is a slightly different analysis. The physical presence standard was traditionally much more associated with sales and use tax because these were sales and use tax cases. But there was certainly an existing position out there taken by certain companies that in states that had not litigated the issue specifically, that income tax also potentially required a physical presence. And again, after this decision, I think both tax types, it's clear that physical presence is no longer required. Although if it's established, I think it would still be sufficient to trigger nexus for both tax types. A lot of the basis of the decision, and as you can see, it was a close one. It was a 5-4 ruling. But a lot of the basis for the ruling was centered around the idea that it created economic distortions. You had a large online company called Wayfair, which was one of 3 of the defendants, that were all large online sellers. And they were selling into South Dakota. South Dakota was the plaintiff in the action. And essentially, they had no sales use tax collection requirements because they had no physical presence in the state. Whereas you could have small mom and pop or brick and mortar stores that are located in South Dakota. They could be selling the exact same products, but they were required to collect sales tax. And in this age of the internet economy that didn't exist when Quill was decided in 1992, the court really believed that this physical presence standard had become too arbitrary. It led to economic distortion effects, and really it should not be required to establish nexus. And they overturned Quill, which is a big deal. Supreme Court typically follows its precedent, and it's relatively rare for the court to overturn its decisions. So when they accepted the case, it was anticipated for sure that this might happen, but it was still an important decision, and the fact that they did overturn it sort of creates a bit of a gray area now, because while physical presence is no longer required, the question for us today is, well, what is sufficient to establish nexus if it's not required? And one of our guideposts is the South Dakota economic nexus statute that they created in order to challenge the physical presence standard. And it has a few important components that are worth discussing. The main one that gets most of the attention is the small seller threshold, where if you don't have revenue over $100,000 or 200 or more separate transactions annually, then you won't establish economic nexus in the state. But as you may have experienced or not, and it can certainly vary state by state, but based on the type of business or industry you're in, 200 transactions could be a very low threshold. If you're selling, car chargers or small pieces like that, you could get to 200 transactions pretty quickly and much faster than you might get to $100,000 in sales. On the other hand, an art dealer or jeweler, someone selling high-end merchandise, could have a single sale and easily trigger that $100,000 threshold. So these are important thresholds to know and understand because, as I'll explain in the next slide, this is what's been adopted by most of the other states and has quickly become effective and enforced by many of these states. The other important provision was that the statute would not be applied retroactively, because the court's decision by interpreting the Constitution and saying physical presence is not a requirement, essentially what that means is that it was never a requirement. It's not a prospective ruling. It's saying that physical presence is not a requirement for the Constitution for nexus before, currently, or going forward. And so this created a lot of concern, quite understandably, in the industry, in the business industry, that companies without a physical presence could suddenly be held for retroactive liabilities. So far to date, what we've seen is most states have adopted a prospective approach, and I'll show the map on the next slide. So the alarm bells aren't ringing quite as loud as they were when the decision was first made, but nonetheless, taxpayers should be aware that the technical and legal requirements allow for potential retroactive liability, and that needs to be considered in any analysis of their nexus footprint. The last parts of this provision that often get overlooked, but I think are an important part of the discussion, is that South Dakota only has one tax rate. As Nancy and I mentioned in the earlier slides, states often have a state level rate as well as a county and some local rates. So depending on where a sale is made, it truly can have a different tax rate based on the street address, one street to the next, zip code, or geolocation. And that can create enormous complexity, as you might expect, for sellers, because without software or sophisticated programs to source these sales, there's really no way manually to know from one street to the next the exact tax rate that might be imposed, because it is layered and it's a combination of state, county, and local rates. So South Dakota simplified that by establishing one sales tax rate throughout the state. That's not true for a lot of other states. Common examples are Colorado or Louisiana, where they have home rule jurisdictions where not just at the state level, but counties themselves can determine what's taxable and what's not, their own tax rates, and they have their own collection and remittance procedures separate and apart from the state. So as you can imagine, for a foreign seller, or let alone any out-of-state seller, this can create enormous complexity. And that's sort of being worked through right now. Those states allegedly are trying to come up with a single out-of-state seller rate or program, but it's very challenging because none of the local communities really want to give up control, understandably, over their tax collection and rates. So what have we seen since the decision? Because again, it's important to note that while the Supreme Court somewhat endorsed South Dakota statute, it didn't establish it as the law by any means or as a requirement for other states to follow. All the Supreme Court technically did was overturn the physical presence standard. So the South Dakota statute is really the best guideline that other states have had to use to work with, because if the Supreme Court said this is sufficient, states have used that as a signal that if they establish something similar, it should be upheld. While this is yet to be tested in the courts and future litigation is expected, as you can see from this slide, already at least half the states have implemented seller thresholds similar to South Dakota. In fact, as of this month, almost half the states are already enforcing their new economic nexus provisions. And that's, if anything, a very important takeaway from today's presentation is that, again, this is not a wait-and-see requirement. This is the new law of the land in the United States. Already half the states are enforcing these new economic nexus provisions. And as of January 1st, that'll include another 10 states. And I would presume within 2019, all 45 states with the sales tax will be actively enforcing these new economic nexus provisions. There are still 14 states, however, that have yet to issue guidance. Again, that doesn't mean technically that they couldn't enforce economic nexus provisions, but as we've seen to date, typically they are issuing some sort of guidance or a declaration about what their rules will be and when their laws will become effective. Again, even though they didn't need to act prospectively, they've generally taken that approach, mostly with incentive to avoid federal intervention. And if there's time, we can discuss at the federal level whether there's any expectation of congressional action or not. But so far, with these new state laws, mostly falling in line with the South Dakota example statute, it's expected that these states will move forward with their own thresholds and standards, and it's unclear whether any federal standardization is likely to take place. It is worth noting that 4 of the largest states, California, Texas, Florida, and New York, have yet to issue formal guidance. But from what we've been following, California, Texas, and New York have already indicated that they'll likely be establishing similar thresholds in early 2019. So if you have significant activity in those states, as many businesses often do, you could consider a wait-and-see approach. But as I would emphasize, and I think the panelists would emphasize today, if you are recognizing these new economic nexus standards and a registration and filing obligation, it probably makes sense to be doing all this together at once, because if they're not effective today, they will be very soon, as I've mentioned, in all the other states. So let me jump to the heat map, and we can go back to discuss this a little more. But PwC closely tracks the state guidance that has come out. And some of the helpful guidelines, one is the economic nexus thresholds. In orange, you can see South Dakota and all the states around it have generally chosen this $100,000 threshold. So if you have sales revenue in the state sourced to that state over $100,000 annually, or as I mentioned importantly, 200 transactions, and it is an either-or test, the state's view is that's sufficient to establish economic nexus, in which case you would need to register and collect sales and use tax if applicable. You can see from the heat map, some states have taken slightly different approaches. Some have a $250,000 threshold. A few have a much lower threshold. Washington, Oklahoma, and Pennsylvania in red are worth noting because they've taken a slightly different approach. Their view is if you have sales over $10,000, which relatively speaking is quite small, of course, the seller has 2 options. They can either register for sales and use tax, or they can follow what are commonly called notice and reporting requirements, which can vary by state, but essentially it means that if the seller chooses not to collect sales and use tax, instead it needs to report, at least on an annual basis, to these states what their sales were into the state and to whom, so the state itself can try to collect that tax from the purchasers. In some respects, this may be easier for sellers because it's technically only an annual requirement. But what I've seen in my practice is that typically creating a whole new system for notice and reporting and following those regulations can be a lot more burdensome on a company than just choosing to file, register, and remit sales and use tax. So that is a business decision, but it's an important consideration, especially in these states with lower thresholds. Another common question we get is that South Dakota, by population, is actually one of the smallest states. In fact, it's notable that the population of South Dakota could actually fit within the city of San Francisco. So you have a state like California, which is, I believe, something like the world's 5th largest economy, just the state alone. Does it really make sense for California to have the same small seller exemption threshold of $100,000 versus South Dakota, which has only a tiny portion of the same population? And that's a hotly contested debate, and as I said, it remains to be seen what threshold California would choose. I think in terms of fairness, it should really be a higher threshold, because if you have sales into California, into San Francisco, and it does go over $100,000, you're now responsible for everything from San Francisco down to San Diego in terms of sales and use tax nexus and a collection responsibility. So while most followers are skeptical about whether California will implement a higher threshold, it would make sense from a fairness standpoint, and so we'll just have to wait and see. as I said, this heat map is demonstrating where states have chosen to start enforcing or make effective their economic nexus provisions. As you can see in the orange, the vast majority chose 2018. In fact, October 1st and November 1st were key effective dates established by most of the states. It was believed largely because they wanted to start enforcing these nexus requirements before the holiday season, so that they could get that tax revenue, understandably, that's so large in the November and December months. But these other states are also choosing early 2019 dates, and as I showed in the earlier slide, as of early January 2019, almost 40 states, 35 or so of the states, will technically be enforcing these laws.
Okay, it's back to me. I feel like I get to do all the bad news. So the nexus rules that Rob's been talking about during this webcast really, as obviously relate to sales tax. And indeed, that was clearly the subject of the Wayfair case. But there are many tax professionals and academians who believe that removing the physical nexus barrier for sales tax also means that state income tax should now also be solely predicated on an economic presence as opposed to a physical presence. Now, this has been the case for a while in my experience, coming up through and serving the financial services industry. That's been kind of around from a financial services income perspective for probably close to 30 years. So why is this an issue for foreign sellers? Well, simply put, many states do not follow federal income tax treaties. They're just not party to them, and would still require state income tax to be filed and paid. In fact, just registering for sales tax filings could often trigger a filing obligation whether or not the company may be subject to the tax. Okay, so it kind of puts the company on the rolls of the state, and even if you don't believe you have the requisite nexus for state income tax, they may still be looking for a filing. So the reality is that roughly 30 states already have some form of economic nexus statutes in the state, okay? And the expectation is that that's going to continue to grow, and probably a bit faster than maybe it would have had the Wayfair decision not been in favor of the state. So there has been for a while some guidelines that were published by the Multi-State Tax Commission, and just to give you a quick synopsis of what the Multi-State Tax Commission is all about, and we abbreviate it the MTC. This is an intergovernmental tax agency. They're not a lawmaking body themselves, but they set out guidelines in an effort to create uniformity across states. So kind of like similar to what maybe the OECD does for the EU in terms of tax, to come up with guidelines of rules that the individual states would then have to adopt. So anyway, they had published a guideline that recommended that states adopt a threshold for income tax that says, if you have more than $500,000 of gross revenue in a state, then that would give you nexus in a state, and therefore you'd be subject to the state income tax. So there's another concept in here, though, for state income tax, and that is this Public Law 86272. This is a law that passed back in 1959 and was designed to protect certain businesses from the reach of state income tax. It protects remote sellers that sell tangible personal property, which of course was never defined, but it only applies to the mere solicitation of that tangible personal property. So if all you're doing is soliciting for sales of tangible personal property, this Public Law 86272 would protect you from having to pay state income tax. And the other limited scope of this law is that it really only applies to tax on net income. So it does not protect a seller from, say, a gross receipts tax or maybe a franchise tax measured by net worth. And there are several U.S. states that have taxes like that on their books. Some of the more notable ones are Ohio, Michigan, Texas, but even a state like Delaware, yes, our 49th largest state in the union, while they do have a state income tax, they also have a gross receipts tax. And I actually participated in a conference where one of the administrators from the state of Delaware made the clear statement that they believe that the Wayfair decision has opened up the doors for them to expect remote sellers to now be subject to gross receipts tax in the state of Delaware. So that's kind of interesting. So I think we're going to keep going in the, got another slide here to cover that I'll get through real quick, so I know we want to try to get to some other concepts here. So if you want to flip the slide, good. All right. So if you find that your business could be subject to sales and use tax, or sorry, to state income tax, it's imperative that you quantify that exposure, right? Because if you're a publicly held company, you may need to set up reserves and disclose those reserves in your annual filings that you have with the Securities and Exchange Commission. In fact, you know, we saw shortly after the Wayfair decision was announced, Wells Fargo, one of our large financial institutions here, reported almost $500 million of income tax expense because it was putting up some reserves for this very issue, for liability for potential state income tax because of this economic presence concept that it believes now puts them at greater exposure for state income tax. So the final point I'll make here is that, and we don't really cover this on the slide, but I just want to point out that, you know, keep in mind that not filing a return means that the state can come looking for tax from a company forever. In other words, you know, the statute of limitations will not apply if there was no return filed. So, you know, keep that in mind as you're trying to sort through your exposure and, you know, what your filing positions are. So, okay, so next, Rob's going to walk through what all this means for foreign sellers.
Yeah, thanks, Nancy. Those are great points. It can be a business decision whether to register or not, whether it's sales tax or income tax. But to your point, even if you are filing 0 returns, it would start the statute of limitations. So there's always an interesting discussion to have around that. But let's get to considerations for foreign sellers. Now that you understand the context, the background, some of the complicated issues or questions to consider, what does it mean, or what's distinct for foreign sellers? Are there any protections, for example, or exemptions that are worth noting or should be considered? And I think the short answer is no. I think that's really the biggest takeaway to understand today, is that there's really no distinction in the U.S. under the Constitution, under these economic nexus provisions, whether you're selling in South Dakota or Texas or the UK or Italy, wherever. If you have customers in these states, if you're generating revenue over these thresholds, technically these economic nexus provisions will apply. They technically apply. To Nancy's point, the federal treaty protection does not apply at the subnational level. So even states, countries, companies with U.S. treaty protections wouldn't apply at the state level. And so sales and use tax and even state income tax remain important considerations and potential traps for foreign sellers that believe that they have full treaty protection. I won't get into the case law behind it, but this slide reflects it, and of course these will all be provided after we present today. So what are the most impacted industries? Well, I think we've talked about that a little bit. Obviously selling tangible property, especially through e-commerce platforms, so companies that didn't traditionally have a physical presence in the U.S., but do sell and deliver tangible goods there. But also, as I noted, digital products and services, things like video games even, software, anything with software components. These are common taxable areas. Digital streaming is a big one, where I've done a lot of consulting recently, because you have companies that are providing digital streaming services, video, audio, other digital platforms, and you may not have an actual physical presence in the U.S., but you do have customers there. You're generating revenue, and a lot of states now tax these different products and services. I also want to mention there's no distinction for B2C versus B2B for sales and use tax. It's technically a question of who the end user is, and businesses often can be the end user of a product or service. Software, for example, companies buy software and hardware that they use in their own business. In that instance, they are the end user, so sales tax would technically apply. These final points are good to go over about multinationals. If you have significant intercompany transactions, sales tax is an entity-by-entity tax type, so it doesn't have concepts as are common, like in state income tax, about consolidated or combined reporting. Typically or traditionally, it's an entity-by-entity consideration, whether each entity on its own has a sales and use tax registration or filing requirement. So multinationals with significant subsidiaries and intercompany transactions need to be readily aware of this. Another important or common topic is enforcement. So technically, there's nothing exempting foreign companies selling in the U.S. from, from abiding by these new economic nexus standards. Well, what about enforcement? I think we list some of the considerations here, and I think the bottom line is that in today's interconnected, flat world, as they say, businesses are so interconnected. If you are doing business in the U.S., you obviously want to try to comply. You want to know the rules and try to comply as best as possible. And while states may be more limited in certain respects than the federal government, as we describe in some of these bullets, there are a number of ways that states could attempt to enforce their nexus requirements if companies aren't complying. And since these laws have become effective in over half the states, it's also important to note that penalties and interest start to accrue. And it's a pass-through tax also. Sales tax is a trust tax, typically that you can pass through to your customers. So you want to try to take advantage of that if you are selling taxable goods and services, to pass that tax through when it's applicable. Otherwise, if you miss that opportunity, it's hard to impossible to go back and collect tax from your customers, and so it becomes a liability on the company directly. So the main question is, what can foreign companies do? And we'll have to speed through this a bit quickly. But most importantly, I think this Venn diagram helps give a quick conceptual view of the big picture considerations. You now have to consider whether you have nexus in a state, whether you're selling taxable products or services, and then what's the materiality of that. And if it's all three, then obviously I think it's clear the company should register. If you only have 2 out of 3, it can become more of a business decision. So for example, if what you're selling is taxable and it's high material dollars, but it's in a state like California that hasn't enacted economic Nexus provisions officially, that's something where you think about, well, we'll monitor it closely, or consider registering now because we know they will start enforcing that soon. So hopefully you had a moment to digest the classic Venn diagram, but I think this helps highlight what your options are and the need to consider those three main things. And lastly, I'll just say that PwC has been carefully tracking all of the state developments. As you can see on this slide, which is a sample screenshot, we're looking at when the effective date has been listed by the state, what their collection threshold is, and the number of transactions. Then we have links to all the guidance available, whether they're a streamlined sales tax member, which we didn't get to today, but over half the states participate in that, and it creates a bit of uniformity. So this is one way to help your company track and compare your business activity to the state activity. And again, we have different filing visualizations because as I wrap up with this part of the review, it can be a complicated road. You have the pre-Wayfair Nexus considerations like physical presence. You have the post-Wayfair considerations now with all these states in economic nexus. So you have to consider where you registered or have not registered and where you likely have a historic liability and potentially a registration requirement going forward. And these are some of the tools that can help guide through that analysis. So with that, I promised James and Nancy that I would leave enough time for them to cover some of the important technology aspects and hopefully still have something left over for Q&A.
So I think we'll be rather quick here. Effectively, we get the good part of the conversation, which is, how can we help? So effectively, the big story is with the new Wayfair laws, thresholds a lot lower, especially with the transactional count. So there's a huge need to be able to evaluate sales tax for businesses that haven't traditionally had to evaluate sales tax. Now, what does that mean? Well, with over 5,000 different jurisdictions, with a variety of different customer exemptions that have to be maintained and monitored for transactions that aren't immediately exposed for the collection of sales tax, and for anybody who sells products like software that has varying taxability, there is a significant amount of research and tracking that needs to go on. Now, the advantage here is there has been companies in the marketplace for over 30 years, like Vertex, who's the oldest and market leader in this space, that provides the software to easily and efficiently do these calculations. So for a very reasonable, cost-efficient approach, the ability to be able to connect into these systems to automatically calculate, track taxability, and maintain exemption certificates is available. So it's a lot more that has to be managed by the tax function, but the key messages that we want to leave here is the fact that the software is in the market, and it's more about supplementing the software to your existing processes in order to make that efficient use. So next slide.
Yep.
So effectively, as we talked about before, the key softwares that are available in the market provide accurate calculations, accurate exemption certificate manages. There's no single format for exemption certificates. There's a variety of different ones that have to be maintained over time, that have to be signature ready, and there's a variety of different return obligations based on the jurisdictions. Nancy covered this earlier, but with local collections, with local jurisdictions below states having the rights to be able to collect tax, means that there's more than 50 returns that are due on average here. On average, our clients end up filing roughly about 100 returns per month. The advantage is with the software, a lot of this can be easily maintained and pushed out at a relatively low cost. Next slide. So the key areas that we'd like to make sure that you consider here is Nexus, making sure that you have your analytics in place to track when you exceed the existing thresholds and monitor as the states consistently change the thresholds. Just because we've marked key thresholds on the diagrams today don't mean that those are going to be the ones going forward. States have the right to change them at any time, and because sales tax is the main funding mechanism for state governments, they will constantly change it to increase their revenue. Tax compliance, making sure that you have a key process in order to maintain and create your returns is pivotal, and also making sure you have a process to respond to audits and jurisdictions as they come back to you is pivotal. Most of the individuals on the call today maintain VAT systems and VAT frameworks for audit. This is an entirely new framework which at any given point you can expect somewhere around 30 auditors to show up and assess your transactional data at any given point. So having the right systems in place is pivotal, and having the right processes interlinked is pivotal as well. But now I'll turn this back over to Rob to summarize, and then we'll move on to questions.
Great, thanks, James. And again, thanks everyone for joining. I know it was sort of a rushed, high-level run-through. We only had an hour today, and we could talk about this stuff all day, and often do. So there's a lot left to be said and discussed, but I think for purposes of today's presentation, foreign companies doing business in the United States, this really impacts all industries, so they need to be aware of the decision. And while all of the old Nexus considerations still apply, like physical presence, obviously it's important to be now aware of these new economic standards as well. It's a bit of a gray area, sort of Wild West, as we say in the U.S., trying to figure out what the new rules are. It does vary a bit by state. And lastly, nothing specific exempts or protects foreign sellers from these new laws and requirements. So as the effective dates have come and passed for over half the states already, you know, now's the time to act, really.
So moving on to questions quickly. We've gotten quite a few, but we'll pick a handful of them very quickly. So Rob, I think we've gotten our favorite question forward, which is, I'm not the importer of record here. Am I still obligated to collect sales tax under these new Wayfair laws?
Yeah, and that is a great one. That's a common question, James, and it, understandably, because it makes sense. And you know, I'm not sure the distinctions between VAT and sales tax, but sales tax is very, very form-driven, and it's a question about who's the seller of record on the invoice. So while there may be different inter-party transactions along the chain, if the seller of record on the invoice, you know, is your company and the customer is located in the U.S., that's likely considered, you know, U.S. revenue towards these Nexus thresholds and potential sales and use tax collection obligation.
Perfect. I am only engaged in B2B supplies. Am I still obligated to collect sales tax under Wayfair?
Yes, that's another common one. It's a good question. Again, maybe some distinctions from VAT, but in the U.S., as I mentioned, businesses can be end consumers. This is a tax ultimately designed to be applied once upon final consumption. So if you're selling to businesses, let's say you're selling software or hardware, things like that, that the business is using, while sometimes exemptions may apply, it's important to note that just because it's B2B does not make it exempt in nature. Wholesale sales that are for resale, however, typically are exempt, and there's just documentation requirements that are also important to know about, because if you sell and don't collect a resale exemption certificate, you're technically still liable.
Excellent. So we've got one more. I'm acquiring a new company. Which Nexus rules should I be looking at to determine historical exposure?
Yeah, in the M&A space, historical exposure is still as relevant as it was before this decision. As we discussed in the presentation, physical presence is still sufficient to establish Nexus and has been. So if you're entering M&A activity and doing due diligence, either as the target or the buyer, you really need to still consider these historical components, and where that company had a physical presence prior to Wayfair could still trigger historic liabilities that should be accounted for within the purchase price.
Perfect. And I think we have time for just one more. What about the fact that the Supreme Court ruled that this should be simplified rules? How does this affect Wayfair?
Well, I guess that's really the challenging question and why there's gray area, because the Supreme Court actually, all it did was overturn the physical presence standard. While it somewhat endorsed South Dakota statutes, it didn't say that these were requirements for the states to establish nexus. So it's a really great question, because while most states have adopted these economic thresholds of $100,000, for example, these other components of South Dakota statutes, such as the simplified tax rate, are often getting overlooked. And I think at this point, we'll just have to see, does it get tested by the courts? Do companies that are overwhelmed by these Colorados or Louisianas decide to litigate? Or do those states modify and figure out a more simplified rate?
Excellent. So I think that is all of our questions right now. For anybody we didn't get to, we will email answers directly after this WebEx. And Neela, back to you guys.
Thank you for listening, and this concludes today's webcast presentation. Any questions we did not answer have been collected, and we will follow them up via email. On behalf of our presenters, PwC and Vertex, I want to thank you all for your participation today. Thank you, and enjoy the rest of your day.